Technical analysis is like reading a map of the financial markets. It helps us understand past price movements. This allows us to make better predictions about future price action. Traders use technical analysis to identify trading opportunities. It is a powerful tool for making informed decisions. At its core, technical analysis relies on charts. Charts visually represent price data over time. By studying these charts, we can identify patterns and trends. These patterns can indicate potential buy or sell signals. Technical analysis assumes that history often repeats itself in the markets. Technical analysis is not about predicting the future with absolute certainty. Instead, it is about understanding probabilities and managing risk. By learning to read the language of the markets, traders can gain a significant edge. They can make smarter trading decisions. Candlestick charts are a popular tool in technical analysis. They provide a visual representation of price movements over specific time frames. Each candlestick tells a story about the battle between buyers and sellers. It shows the opening, closing, high and low prices for that period. A long green candlestick indicates strong buying pressure. This is where the close is significantly higher than the open. Conversely, a long red candlestick suggests strong selling pressure. Here, the close is much lower than the open. Short candlesticks with small bodies, on the other hand, indicate indecision or consolidation. There are many candlestick patterns that traders look for. These patterns can provide clues about future price movements. Some key candlestick patterns include Doji. A Doji candlestick has a very small body. It signals indecision in the market. Hammer. A hammer has a small body at the top of a long lower shadow. This suggests a potential reversal from a downtrend to an uptrend. Engulfing. An engulfing pattern occurs when one candlestick completely engulfs the previous candlestick. It indicates a potential change in trend. Shooting star. A shooting star has a small body at the bottom of a long upper shadow. This suggests a potential reversal from an uptrend to a downtrend. Trend lines are one of the most basic yet powerful tools in technical analysis. They are simply lines drawn on a chart to connect a series of prices. These lines help traders visualize the direction of the trend. An uptrend line is drawn below a series of higher lows. This indicates that buyers are in control. A downtrend line is drawn above a series of lower highs. This suggests that sellers are in control. Support and resistance levels are also important concepts. Support is a price level where buying pressure is expected to be strong enough to prevent the price from falling further. Resistance is a price level where selling pressure is expected to be strong enough to prevent the price from rising further. Moving averages are another useful tool. They smooth out price data by creating a constantly updated average price. This helps to filter out noise and identify the underlying trend. Two common types of moving averages are simple moving average, SMA. This is calculated by adding up the closing prices of a security for a specific number of periods, and then dividing the sum by the number of periods. Exponential moving average, EMA. This gives more weight to recent prices. This makes it more responsive to changes in trend. Momentum indicators are like the speedometer of a car. They tell us how strong or weak the current trend is. This helps traders identify potential overbought or oversold conditions. One popular momentum indicator is the Relative Strength Index, RSI. The RSI is plotted on a scale of 0 to 100. A reading above 70 is generally considered overbought. This suggests that the price may be due for a pullback. A reading below 30 is generally considered oversold. This suggests that the price may be due for a bounce. Another widely used momentum indicator is the moving average convergence divergence, MACD. The MACD is calculated by subtracting the 26-day exponential moving average, EMA, from the 12-day EMA. The MACD oscillates around a zero line. A bullish crossover occurs when the MACD line crosses above the signal line. This suggests that bullish momentum is increasing. A bearish crossover occurs when the MACD line crosses below the signal line. This suggests that bearish momentum is increasing. Section 5. Chart patterns. Recognizing repetitive market structures. Chart patterns are like footprints in the sand. They provide clues about the future direction of price movement. These patterns are formed by the repetitive price action of traders in the market. By learning to recognize these patterns, we can anticipate potential breakouts, reversals, and continuations. Understanding chart patterns can significantly improve our trading decisions. Some common chart patterns include head and shoulders. This pattern indicates a potential reversal from an uptrend to a downtrend. Double top and double bottom. These patterns signal potential trend reversals. Triangles. These patterns suggest a period of consolidation before a potential breakout. Flags and pennants. These patterns indicate a potential continuation of the current trend. Section 6, Head and Shoulders Pattern, identifying potential reversals. The head and shoulders pattern is a bearish reversal pattern. It is one of the most reliable chart patterns in technical analysis. This pattern is formed after an extended uptrend. It signals that the uptrend may be coming to an end. The pattern consists of 3 peaks: the left shoulder, the head, and the right shoulder. The left shoulder is the first peak formed during the uptrend. The head is the highest peak, representing a final surge in bullish momentum. The right shoulder is the final peak, usually lower than the head. The neckline is a crucial element of the head and shoulders pattern. It is a trend line connecting the lows of the left shoulder and the head. A break below the neckline confirms the bearish reversal and signals a potential sell opportunity. Section 7. Double tops and bottoms, confirming trend changes. Double tops and double bottoms are another set of important reversal patterns. They signal a potential change in trend. A double top pattern occurs after an uptrend. It indicates that the buying pressure is weakening. The pattern is formed when the price reaches a certain level twice but fails to break above it. This creates 2 distinct peaks at roughly the same price level. The neckline is drawn connecting the low between the 2 peaks. A break below the neckline confirms the bearish reversal. This signals a potential sell opportunity. A double bottom pattern, on the other hand, is a bullish reversal pattern that occurs after a downtrend. It's formed when the price reaches a certain level twice but fails to break below it. This creates 2 distinct bottoms at roughly the same price level. A break above the neckline, which is drawn connecting the high between the 2 bottoms, confirms the bullish reversal. This signals a potential buy opportunity. Section 8. Triangles, flags, and pennants continuation patterns. Triangles, flags, and pennants are continuation patterns. They indicate that the prevailing trend is likely to continue after a brief pause. Triangles are formed by converging trend lines. These lines represent a period of consolidation where the market is taking a breather. Flags are formed by 2 parallel trend lines sloping against the prevailing trend. They resemble a flag on a pole. Pennants are similar to flags. They have converging trend lines that create a triangular shape. Traders often look for a breakout from these patterns in the direction of the prevailing trend to confirm a continuation. A breakout above the upper trend line of a triangle, flag, or pennant in an uptrend would signal a potential buy opportunity. Conversely, a breakout below the lower trend line of these patterns in a downtrend would signal a potential sell opportunity. Section 9. Practical example. Combining technical tools for trading decisions. Let's say we are analyzing the price chart of a stock and notice that it has formed a head and shoulders pattern. The neckline is drawn and the RSI is showing an overbought condition above 70. Additionally, the MACD indicator is showing a bearish crossover. This confluence of technical signals suggests a high probability of a bearish reversal. As a trader, we would look for a break below the neckline of the head and shoulders pattern as a confirmation to enter a short position. We could place our stop loss order above the right shoulder. We aim to capitalize on the potential downtrend. Remember, technical analysis is not an exact science. It should be used in conjunction with sound risk management principles. By combining various technical tools and understanding their strengths and limitations, traders can make more informed trading decisions. Practice and experience are key to mastering technical analysis.